All right, so we have different funding and financing model for real estate. Funding, we mean that you want to develop a property, you want to buy a property, and you're asking yourself, oh, I don't have all the money to develop this property. I don't have all the money to buy this property. You have two options. You are either getting fund or getting finance for that project or for that property, either via debt or via equity. And in this episode, we will look at the differences between using debt to fund a real estate purchase or a real estate development, and using equity to fund a real estate purchase or a real estate project. All right, in case you are coming across a video like this for the first time, this Meet the Public Property channel, and this one covers everything in real estate for first-time investors, avid investors. We share everything that you need to know, guides, advice, everything, and you definitely don't want to miss any of our videos, and that's why it's important for you to subscribe. This is your first time here, this is your second time here, this is your fifth time here. Subscribe to our videos, subscribe to our channel, so that as we are dropping these videos, as we are dropping these guides, you get notified and you don't miss any of them. All right, so debt versus equity in real estate. Now, this is not just if you want to develop a property, and this is not just if you want to buy a property. So I'll be talking to both property developers and property buyers. So this rule applies to if you want to buy a property and you want to buy a 4-bed duplex in Lekki, you want to buy a 2-bed apartment in Aja, you want to buy Maison 8 in Ilukbeju or in Surulere or in Yaba or in Ikeja, and it's 200 million, it's 300 million. You only have 30%, you only have 25% of the entire capital. You want to develop a building or a project, is 22 units, is 20 units, is 25 units, it's going to cost you 1 billion, and you only have like 200 million or 300 million, and need to raise funds or to raise capital. So you're either going to be raising capital via debts or you're going to be raising capital via equity. All right, so I'm going to start with equity. All right, now for a couple of people that are business owners, entrepreneurs, they already understand the difference between debt and equity, because this same thing also applies in businesses too. Businesses either raise funds or raise capital via debt or raise their capital via equity. No other two ways. You are a startup, you are at the growth stage, you are the expansion stage, you are always in the market looking for funding or looking for financing. Is that you are taking debt, which is loan, or you are giving out equity, which is like what a lot of people do when they go into the stock market and then start selling their shares. The commercial banks in Nigeria did that last year. I think recently too, they are telling the discos, the electricity distribution companies also to recapitalize also. So those gives the public an opportunity to invest and give you fund, give you capital in exchange for equity in your business. All right. So the same thing also applies to real estate too. So I want to buy a property for 200 million. I have, let's say, 30% of that, which is like 60 million, and I'm looking for a 140 million. So the first option is, okay, how can I tell people to give me 140 million, and in exchange for a percentage in this property? That's equity. You understand? So as I'm giving you the 140 million, probably maybe one person is giving 140 million, or two people are giving you 70 million to add to the 60 million naira that you have. They are also going to be co-owners. They are going to be co-owners in that property too. So you don't 100% own that property, but now you have co-owners that owns that property. So your 60 million gives you 30% equity. If someone else bring in the 140 million, that person owns 70% equity. If it's 70 million, two people are beginning to bring up the complete the 140 million, they own 35% equity in that property. So that's equity funding. As simple as that. Equity funding. So you may now wonder whose names or name will be on the property. Is it that who owns the highest share? that's the person's name that will be on the property. No, that's not correct. So it's either two ways. It's either in the deed of assignment, the name of everybody is there, which is not advisable, because if the name of everybody is there, that means everybody has the same equity on that property. So because there are different equity percentage, someone owns 30%, another person owns 35%, another person owns 35%. The best vehicle is to own that property in a corporate name. So each person who is the co-owner of that property will be a shareholder in a new company that we are going to create. Then the company will now be the one we hold that particular asset in its name. So by that way, the percentage each person has in the company represent the same percentage each person have in that property. Now, let me just give you a simple diagram. So we have assets, we have corporate entity, and then we have, let me call them equity owners. So equity owners, EO, 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 EO. So these equity owners, these four people, are the people coming together to contribute 200 million. These four people are the one that come together to contribute this 200 million. So they are the shareholder of this corporate entity, while this corporate entity is the holding company for these assets. So these assets will be in this company's name, and these people, these four equity owners, are the shareholders of this company. Now, how the corporate world works is that any assets in a company, any asset owned by a company, is also part of the assets of the shareholders. So which means that since this company owns these assets, each of these equity owners has a percentage equity in these assets automatically. So out of this 200 million now, if this person brings 20 million, this person brings 100 million, this person brings 40 million. So that's 20, 100, 40, 120, 160, and this person brings 40 million too. We are going to share their percentage ownership to this company. So 20 million, 100 million, 40 million, 40 million. So this person, equity owner A, owns 10%. So this person, equity owner A, owns 10% of these assets because he's a shareholder in the company. This equity owner 2 owns 50% of these assets because he's a shareholder in this company. Equity owner 3 owns 20% in these assets because he's the shareholder of this company. And equity owner 4 owns 20% of these assets because he's a shareholder of this company. Now, things are going to become trickier if another asset is owned in the name of this company. And that's why this, for equity real estate, the companies that we create are called shell companies. They are simply for holding assets. They are not for operations. So, and then each asset holding company will be for a specific asset. So which means that if these four people want to buy another property, they are going to create another company again, another corporate entity to buy that second property, not the same one again, particularly if that percentage is going to be changing. So let's say there is another property for 100 million, and these four people want to buy that property again, but this time around, this person is contributing 20%, this person is contributing 30%, this person is contributing 25%, this person is contributing 25%. They can't register that second assets in this corporate name again, because the percentages of them are contributing is already different from the percentage they hold in this corporate. So they will create another different asset holding company and put in the percentage, the shareholding percentage of each based on what they contribute, and then that new asset will be held in that new asset holding company. So in a nutshell, you need a lawyer. All right, so that's the entire model about equity real estate anyway. If you are buying, really, so you are giving out equity percentage in that property, you are giving out percentage ownership in that property for other people to join capital with you, equity. Now, if it's development, that's you are not a buyer now, you want to develop the property, you have already bought the land or signed the JV, and then the entire construction is going to cost you like maybe, let's say, like 1 billion, and you only have like 300 million, and you need 700 billion for you to build or develop that project. You can also go into equity. So based on your projection, you have looked at it that, okay, if we develop this project at full development, full delivery, this project will be worth, let's say, 2 billion. You have add all your costs together, 2 billion, and everything that is going to cost us to deliver this project is going to be like, let's say, 1 billion, for example. It's just an example. Don't say, Rabbi, we have 1 billion. How can I turn it to 2 billion? All right, so it's 1 billion, and then you have 300 million out of this 1 billion. So you can walk up to equity investors that, okay, give us 200 million, or give us 300 million, or give us 700 million. Okay, I'm looking for 700 million, for example. Give me 700 million. Now, out of my 1 billion profits, I'll give you 30% of the profits, or 50% of the profits, or 20% of the profits, whatever percentage of the profits. So automatically that person becomes an equity shareholder in that investment too, because a percentage ownership in that property now belongs to that person. So I can say that, okay, I'm giving you 40% equity, 30% equity in this project. At delivery, the project is like 2 billion. If I give out 50% equity, it means that at delivery, that person has 1 billion. Give me 700 million, I'll give you 50% equity in the project. I deliver the project is 2 billion. That means you have 1 billion. As simple as that. So that's another way to also raise funding. Another way that developers use anyway is just selling as off-plan. Off-plan is also like equity too, because those houses that they are selling at pre-launch, or those units that are selling at off-plan, if they don't sell it at that period of time, if they are selling it at full delivery or full completion, they can sell it higher. So let's say they sold the 4-bed duplex at pre-launch at 50 million per unit, for example, and they sold 10 units. 10 units now, they have made 500 million. So they have sold equity of 10 units. They have sold ownership of 10 units out for them to get 500 million. Even though, if they deliver that project, that each of those units they sold at 50 million, they can sell it at 100 million. But they need money. But at least there is money to deliver the project first. You understand? So selling at off-plan or selling at pre-launch is still part of equity funding too, because they are releasing those slots or those units out so that they can be able to raise capital, even though those units can give them more profit if they do it themselves, but they don't have the money to do it themselves. So they rather just bring down the price, allow people to buy in or take in those slots. Them, they can have capital to go and build, and those people that buy those slots also can make profits. So it's a win-win. They have capital because people buy at 50 million per unit. 10 units, they have 500 million. They have capital, developers. Then investors that bought at off-plan or are bought at pre-launch, they enjoy capital appreciation, which is that project they bought at 50 million each now. That project at delivery is now 75 million or 70 million or 80 million. That's the incentive to investors. You get. So buying at on off plan, buying at pre-launch is still the same thing as the developers or the companies also selling some form of equity on that project, also for them to be able to raise capital. So we'll be going next now to debt financing in real estate.